Jatin Khemani joins us, managing partner is here with Stalwart Investment Advisors. Jatin, hi, good to have you on ET now. Let's understand what you make of today's, the recent market action. We've come up in a linear manner, 15% for the Bank Nifty, 10% for the Sensex and benchmark indices, on an average 20 to 25% for good quality small and mid cap stocks. What would you make of the market setup right now?
Hi Nikunj, thank you for having me on this show. It's a pleasure to be here. Of course, market has surprised most of us. Last 3 months have been phenomenal, especially when you look outside the index. Most stocks have gone up 20-25%. We are at lifetime high today. So I think this partially is explained by the flows, right? So if you step back and see last couple of years, I believe FIIs put together would have net done an outflow of anywhere between 4.5 to 5 lakh crores, right? And just in last 3 months, they have pumped back some 40,000 crores, less than 10% of what the outflow was. And we already are at lifetime highs. So add to that the steadiness of the DII flows, right? We have 13, 14, 15,000 crores coming steadily from the domestic investors. In terms of SIP alone, credit where due, all the MF Sahi hai, the wealth ecosystem has actually ingrained this in the mindset, which is now proven to that even in a bad patch of last couple of years, when markets did not practically go anywhere, the SIP flows have remained very strong. So now when both put together are playing out at the same time, we have FIIs coming back, and we also have the steadiness of DII flows. The markets are where they are, right? They're at lifetime highs. Now to predict, it's impossible, right? What would happen to FII flows from here on, how the global macro would move. As we know, in the short term, markets are a voting machine, right? And votes can go anywhere based on the sentiment. It's an impossible task to do. But having said that, the FII flows have just reversed. We've just got a fraction of what we got back. It'll be exciting to see how the liquidity-driven rally plays out, and then it'll be back to over a medium term. The baton would be passed back to earnings and fundamentals, and we would have to see how those play out, because that's the other part of your return, right? First is the valuation where you stand and the flows, and the other is how the earnings move forward. So if I can add, in terms of valuation, where do we stand today? The consensus estimate for Nifty EPS next year is roughly, let's say, about 1,000. And as it happens every year, like a tradition, we will have downward revision every quarter as we go forward in the year. And let's say we end at 950. Now, if Nifty EPS is expected to be at 950 for FY24, and we are somewhere at about, let's say, 18,900.
Right. Jatin, so just give us a color on where is it that you are still finding value in the market, and what are your overweight recommendations?
I am afraid I would not be able to talk about recommendations. We are registered. Sure. We might have ownership in the stocks discussed. So that's the tricky part. But I can talk broadly about a couple of things. So a space which we really like is manufacturing and engineering. And an opportunity from there where we have been invested for a while and which has done very well for us is Usha Martin. So they are expanding capacity, and although a lot of re-rating has already happened, but from an earnings standpoint, it seems interesting. Now, while that was a special opportunity, the other theme we like to play is mean reversion. The best of businesses, the best of industries go through bad patches, and when you identify them during that weak phase, you tend to make significant money when things turn around. So one space which fits really well is dairy sector. I can just briefly share. Last couple of years have been a rough patch for this sector due to COVID. The farmer community could not vaccinate the cattle properly. There was a lumpy skin disease. Procurement prices crashed, and the fodder prices went through the roof. So a lot of things that could go wrong went wrong for this sector. As we stand today, I believe a lot of things are getting resolved. You have 4-5 listed players, right from Hudson, to Heritage, Dodla. You do your bottom-up research and pick or make a basket of it. But from a top-down standpoint, the sector looks interesting from a mean reversion perspective.
It's a very interesting array. Is there a conscious reason why you invest more in mid and small cap stocks and not in large cap stocks? I mean, is that a conscious strategy? Because what we've discussed so far with you are largely mid cap names.
Absolutely, because it's far easier to create alpha in small and mid caps, which are less tracked and which are outside the scope for most large institutions, most large investors. So you have better opportunities there. Also, the large caps are part of index too, so they get so many flows. There is no information or analysis arbitrage there. Whereas if you do deeper research on small and mid caps, you are active on the ground, you do your scuttlebutt. I think there are a lot of gems, and your opportunity size suddenly, your universe increases to 1,500, 2,000 names. Whereas in large caps, you're restricted to top 100, top 200 companies, which are very well discovered, tracked, and hence very difficult to create alpha from. Of course, the behavioral edge still lies there too. In a bad cycle, you buy even a large cap and you tend to make a lot of money. But I'm talking in general, the alpha creation opportunity present itself more often than not in the broader markets.
Sector where, in general, I've seen over the years, large money has been made by big banks, by big NBFCs. How are you approaching that space? Because if you're a mid cap and a small cap investor, then are you giving financials a skip?
Not really, but at the same time, we don't want to have 40% in financials. And the reason is very simple. See, I am fairly bullish on the economy to do well over the next 5 years, but I'm not sure if the index will represent that, right? Because the representation from BFSI sector in real economy is 6-7%, while in index it's 40%, right? And some of the really great wealth creation opportunities which we had in last 10 years were not even part of index. So chemicals was not there in index. Healthcare has a minuscule representation in index, and so on and so forth. So a lot of these companies would make it to index once they have delivered phenomenal returns. Coming back to your question, when it comes to banks, we strongly believe you don't invest in the bank, you invest in the banker, right? And again, the view is 5, 10, 20 years, not next week, next quarter. For them, the monitorables will be different. For us, being long-term investors, we strongly believe that we invest in the banker and not the bank. And when you look at that, your opportunity size suddenly is very limited universe. You know, bankers who have seen multiple cycles and their asset side is also tested as well as their liability side is tested. And they have stood the test of time, and they have conservatively run the show without big damage, even in the worst of the times. So as we can guess, there are very few names, even in large caps, which meet that criteria. And we do have exposure there. So it's not that we altogether ignore large caps. If we have a growth at reasonable price opportunity where we can make 15-20% CAGR, we happily look at large caps and have exposure to that side.
Stay with us.
Shift gears, Jatin, and talk about a sector where mid cap has done better than large cap, and that's IT. Different companies in the mid cap space have outperformed large cap companies like Infosys, TCS, and even for that matter, Tech Mahindra in last 1 year. What is the best way to understand this entire tech cluster?
I suppose the underlying factors which I just explained, how small and mid cap operates versus large cap, is also true for this question too. So a small or mid cap IT company would have more exposure to a certain section or certain geography or certain type of clients, which may or may not be impacted that much. Whereas if you talk about a TCS or an Infosys or an HCL, they are so large, they have practically exposure to all the sectors, all the large clients, all the large geographies. And when there is a macro slowdown and you are the largest player, it is impossible to escape that, right? But if you are a niche small cap or a mid cap IT company or a product company, you may or may not get impacted to that extent versus your larger peers.
Right. Okay, just want to see what else is buzzing in the market. There's Lupin as well. Of course, it's a news-based reaction. That stock is holding up a solid 5.5% as we speak right now. So that's a big buzzer in trade. In fact, quite a few of these pharma names are doing quite okay. They've got the US FDA approval for generic Spiriva, which is the first generic player to get approval for this blockbuster drug. and some of the brokerages are estimating a gross and net sales of the brand around $1 billion to about $500 million respectively. So that, of course, has put Lupin in a different sort of trajectory today. Idea as well is bouncing up in trade. There's MFSL, which is also holding out. And most of the HDFC group stocks are the ones which are actually comforting the markets today. So HDFC Bank and HDFC Life really has been on a one-way move up. That continues to hold out even in today's trading sessions. Jatin, I'm not sure if you're looking at the insurance space at all and the kind of recovery that they've made from those budget time lows.
That is actually a space which we like, and we like life insurance better than general insurance, given the competitive intensity and the ease of ability for new players to enter. We believe life insurance, in terms of penetration, in terms of the advantage incumbents enjoy from a credibility network standpoint, is here to stay. And there could be near-term challenges on growth or otherwise, but from a long-term standpoint, this sector looks pretty interesting, and valuation too, while the stocks could be at 52-week high or something like that. But I believe from a valuation standpoint, a lot of them have seen time correction over the years, because last 2-3 years they did face some headwinds, and providing opportunities for people with longer time horizons to build positions slowly and steadily.
Okay, Jatin, great to have you on the show today. Thank you so much for taking the time out. Let's just revisit what the market is up to